Hi, welcome to our channel Quids In. I'm Heloïse Greeff and I'm one of eToro's most successful popular investors. I'm currently being copied by 20,000 users on my eToro portfolio, and I've been featured in Bloomberg, The Economist, and a number of other popular media channels. So, one of the great things about technology is that it's rapidly changing the landscape of a lot of sectors, and in particularly the finance space, where we have been experiencing a bit of a revolution over the last few years. And it's being referred to as the rise of the retail investor. So, if you're watching this, you're probably already a part of that movement, or you're interested in learning more about what others are doing to take advantage of the democratization of the internet and to take more control of your personal finances. Today, we'll be talking about market cycles and investing strategies according to that. But before I start, let me make it clear that I'm not a financial advisor, and what I'm talking about today in the video is not to be taken as financial advice. Please advise all my listeners and watchers to do your own research and to manage your risk according to your own personal circumstances. And please remember to subscribe to our channel by hitting the bell icon to receive regular updates about investing and everyday finances as we continue to release more videos. So, with that, let's jump into market cycles. So, as we know, the stock market moves up and down in recurring cycles, gaining ground for a period which is popularly known as the bull market. Then it reverses and falls for a time before heading back up again. Generally, a falling market has to drop for at least 20% before it's considered a bear market. Sometimes market trends can last for months or even years, but historically, we know that we've seen bull markets tend to last longer than bear markets. So the upward swings or trends historically have always tended to last a bit longer than the downward trends. Um, but drops in the market tend to happen quite quickly, and the gains tend to take a lot more time. And it's a lot like gravity for those of you who are familiar with physics. It takes a lot longer to climb 1,000 feet than it does to fall that same distance. And so markets also experience corrections or kind of across the board losses that aren't as severe or sustained as a real bear market. So the stock market is usually priced for the future, but it tends to react to the present and is very heavily driven by people's emotions quite often. So, when we're in a bull market, there are typically some factors which we associate during those periods. And these will include having ample money supply going into the economy, for example. We'll perhaps see some tax cuts during those periods. There'll be low interest rates. There'll be high employment. There'll be political stability, or at least the expectation of stability. And conversely, during a bear market, there are some general negative factors which we can identify. These will include tight money supplies being restricted flowing into the economy. Taxes typically tend to increase. We can see high interest rates which offer better return in less risky investments, high unemployment, and probably some international conflicts or pending elections or just general instability in the global economy. So pinpointing the bottom of a slow market or the top of a hot market is almost impossible until after it has already happened. And it's generally quite difficult to predict which companies will falter during a downturn and which ones will survive or prosper during difficult times. And as I've said earlier, no economic cycle repeats itself precisely every time when we compare it to the previous ones, but we do tend to study the historical cycles to help us get a better understanding. So the pressure that the company faces in one recession are never really exactly the same as what they face in another. And so in most cases, the long-term financial success depends more on the internal strength of a company rather than the goods or services that it provides um, during that state of the economy. One of the most important aspects of investing or trading is therefore one's emotional discipline. Emotional resilience is required to stick to that predefined strategy which you have before going into the stock market, and it allows you not to react to this roller coaster ride of the market cycles going up and down. So let's talk about some strategies that you can use to prepare for these market cycles. I have four main ones which I use in my Toro portfolio. Number one is discipline. Discipline, discipline, discipline. You would have heard me say this so many times before. A study actually showed that if you missed the 10 best days in the market since 2009, you missed out on 50% of the gains. Imagine that 50% of gains in 10 days. What this tells us is that trying to time the market is futile in the long term. And time in the market is more important than timing the market. It's a really old saying, and so many people avoid this one. It's all about dollar cost averaging. If you continuously buy throughout and not try to time the market, you'll eventually have the long term benefit. Number two, diversify. Diversify, diversify, diversify. Again, being overexposed to a single stock is just significantly increases your exposure and your subsequent risk to any fluctuations in the market cycle. And we're seeing a lot of rallying with what is being called meme stocks. So, Ray Dalio suggests that in order to monitor your downward risk, you need 15 uncorrelated stocks in a portfolio. My portfolio on eToro is much more diversified than that. Before the pandemic in March last year, I was holding between 25 to 30 stocks at any given time. For the last year, since April 2020, I've been holding around 40 to 50 at any given time, as well as hedging my portfolio using cryptos or indices and by holding larger cash reserves to prepare for these corrections. So, diversification is an incredibly powerful tool to buffer against these volatile market movements. Number three, diagnose. Diagnose the stocks that are your biggest losers, identify them and drop them. You don't want to be tempted to double down on those losers in your portfolio. So, every portfolio has them, they're inevitable. Not every decision you're going to make is a winner, and not every prediction is going to turn into reality. And being able to diagnose early on which ones are those losers is much more important than trying to avoid them. Having a 3% position going to zero can be tolerated to some extent in most portfolios. But what you don't want to do is continue doubling down, and eventually you end up with a 15% position going down to zero. Of course, what we define as losers is different for each portfolio, and how much drawdown we tend to tolerate from these losers also varies depending on the strategy and the overall objective of the different portfolios. On eToro, I tend to choose my stocks quite carefully to anticipate low to moderate risk. And because I carefully select these stocks in my portfolio, on my eToro page, you'll see that my maximum daily drawdown is about 4.5%, and I have an annual drawdown of 10%. So you can see that I don't use stop losses because I don't tend to choose stocks which are expected to be that volatile. And instead, I carefully pick stocks that I want to add to my portfolio and then identify good prices at which to buy them. So, in diagnosing these losers, you're really accepting that you will have losers. Statistically, portfolios tend to have about 40% of these picks. And the most important thing is just to identify them early and not continue doubling down on them. Number four, defer. Defer selling your winners. It can be really tempting to sell the winners in our portfolio. And it's almost human nature to sell our winners to cash in on those profits. Because ultimately, that's why you're risking your capital in the first place. But just like you will bound to have losers and you should identify them early and cut them from your portfolio, this opposite is true for identifying high value winners. By adding to them over time, you can ensure that that part of your portfolio continues to grow and becomes a larger part of your overall portfolio. Market cycles describe the upward and downward trends that we see in the stock market. And we're currently in the longest bull market in history. Means that for some of us, we may not remember the extreme emotions that market volatility and a bear market can bring with it. However, by relying on these four core principles, we can rest assured that our long term strategy will be rewarded. And they're really that simple. The four core principles are number one, discipline. Have a strategy and stick to it. Number two, diversify. Diversifying your portfolio reduces your overall risk to market fluctuations. Number three, diagnose. Diagnose your losers and cut them from your portfolio early on. Statistically, you're bound to have them, and so all you can do is keep an eye out for them and remove them from your portfolio. And number four, defer. Defer selling your winners. The longer you can hold them in your portfolio or even continue to add more to your portfolio, you'll grow your high growing part of your portfolio. So these were the four core principles to deal with market cycles in your portfolio. And although periods of volatility and market corrections can be extremely unsettling, these offer an important opportunity for strong re entry, which will ultimately pay off in the long term. Thank you so much for joining us today and making it to the end of the video. It was an absolute delight to share with you some of the strategies that I use in my eToro portfolio to deal with market cycles. If you like the content in this video, subscribe to our channel for more in future, and remember to hit the bell icon to get notifications with regular updates on investing and everyday finances. Until next time, bye!